Okay, guys. In previous videos, I explained the concept of liquidity and market structure, trading a range, and today I'm going to go into details about supply and demand zones. Okay, oftentimes you see a lot of traders incorrectly mark out um, the supply or demand zones. Okay, so I'm going to be looking at what supply and demand zones, what they are, how you can map out high probability zones that are more likely to hold, and general things you need to pay attention to. All right, so and then I would try to correlate the concept of supply and demand zones to previous concepts that I have covered. All right. Now, let me quickly say that usually when I'm looking to enter into a trade, there are two things that makes me begin to study price. In other words, I want to take a trade. The first thing I try to pay attention to two things. Okay, before I start looking at the chart and paying attention to price action. The first thing is liquidity sweep. Okay, maybe a significant buy side liquidity has been taken, or sell side liquidity has been taken, or price is mitigating a higher time frame supply or demand zones. Okay, so if my supply or demand zone is not correctly mapped out, that means everything else I will do after that is most likely going to be wrong. Okay, so it's important that you understand supply and demand zones and you are able to accurately map out the high probability ones. This is very vital. This is important because that is what will frame your trades. Okay, usually when you map out you know how I trade, usually I map out my higher time frame supply and demand zones. I wait for price to trade into it, then I go to the lower time frame to look for confirmation before taking the trades. Okay, so if I am not marking out the high probability zones, then that means everything else I'm going to do after that is more like a waste of time. You understand? So, what are supply and demand zones? Okay, supply and demand zones are basically areas where banks and financial institutions put in huge money into the market, where they are looking to fill their orders, or where they fill their orders, where they got into the market. That's basically supply and demand zones. And usually when these big money players, when they enter into the market, they leave footprints on the chart, okay, in the form of supply and demand zones. All right, so what we are looking to do as retail traders is to follow their footprint and enter where they are looking to enter. Okay, I'm going to explain the whole mechanism and how it all works. All right, so that's pretty much what supply and demand zone is all about. Now, how do you map out your supply and demand zones? Okay, before I explain how you map it out, let me first explain how they are formed. In let me get rid of this. Okay, so when price is in an uptrend, when price is in an uptrend or a downtrend. Okay, let me use a downtrend as an example. Price makes a lower low, and then makes a lower high, makes another low, a high, a low, a high. Usually, um when price forms one impulse leg, it will go back up to mitigate the supply zone that forms. Okay, so you have some kind of supply zone somewhere here. Okay, so usually what happens is that after price breaks a low, okay, it's going to go back up to mitigate the supply zone. So what you have here is supply zone, and what you have at the low here when price is moving up, the origin of the impulse is usually where you have the demand zone, and the origin of the impulse when price is dropping is usually where you have the supply zone. I'm going to explain how you map it out, but I'm basically just explaining the basic principle. So, usually in a downtrend, when you see the supply zones, you can see these are the demand zones. When you see that demand zones are constantly getting mitigated, not just mitigation, they are constantly getting price is sweeping through them. Okay, price is sweeping through the demand zones in a downtrend, okay, and usually the supply zone will hold. So when price breaks through a demand zone, price will usually go back up to the supply zone before rejection, breaks another low with the demand zone around that low. Once that happens, price goes back up to retest the supply zone and continues. Okay, so this is usually what you see in a downtrend. Okay, similarly in an uptrend, you can see that this becomes the demand zone, this becomes the supply zone. So in an uptrend, what we see is that the demand zones will hold, while the supply zones will price will trade through them. Okay, so you don't expect to look for an entry in a supply zone when price is trading up. Okay, so generally in a downtrend, supply would hold while demand would be violated. And in an uptrend, demand will hold while supply would be violated. This is usually what you see. Okay, now how do you correctly map out your supply and demand zones? Okay, now before you can have a good understanding of how to map out your supply and demand zones, important you understand how supply and demand zones are created, or um, um, areas on the chart that allows you to know that okay, this is where the big money players are entering the market. Okay, and there are two ways to identify it. Okay, one, you have the pivot created zones and you have the range created zones. Okay, so the range created zones are formed when price is caught between two price points and begins to range. Okay, so a price forms a range and then breaks out of that range aggressively. Okay, that range, the whole of that range becomes a demand or supply zone. Let me show you an example um, on BTC. Okay, you can see from here that price is caught within a range. Okay, the whole of this is a range. Okay, this is a range. Okay, this is a range. So from the high to the low, the whole of this area is the supply zone. Okay, you can see that price was ranging in between this point, just ranging, going up and down, and then all of a sudden there was an aggressive move out of it. Okay, immediately you see this aggressive move, that is really what validates this area as as the supply zone. Okay, so this is an example of a um, range created supply zone. That's a typical example of a range created supply zone. All right, let me show you other examples. Um, this time. Okay. All right. Yeah. So So, like I said, this is an example of a range created supply zone, and you can also see from here that there is a small range, not very obvious, but you can see that there is a small range here. Price was ranging. When you go to the lower time frame, you see more clearly that price was ranging between this point, and then all of a sudden there was an aggressive move away from that point. Okay, so this is a typical example of a range created um, supply zone. Okay, same thing applies here. This is demand. This is for demand. This is a range created demand zone. Okay, so price is caught between two price points, and all of a sudden there is an aggressive move away from that zone. So when price taps back into it, you would usually see a kind of reaction. So this is how you map out your supply zone. I mean your demand zone. If you see a range, you just select the top of the range to the low of the range. Okay, this is your demand zone. Same thing applies here. Same thing applies here. This is a range, and all of a sudden there was an aggressive move away from that range. Price taps back into it and sold off. Okay, so what you want to see for range created zones, you want to see that range and then an aggressive move away from that range. Okay, so that's range created supply and demand zones. Other examples, this is also a range created zone. This is also a range. You see price um caught in between two price point moving up and down. Not very obvious on the 4 hour. When you go to the lower time frame, you see that this is a range. This small price action here. This is 1, 2, 3, 4. This is like 12 hours of price action just caught in between this price point. So that's a range. This is a range created um, zone. Okay, so there are other examples. Okay, so that's that for range created zones, and you also have pivot created zones. Pivot created zones are formed when price all of a sudden makes a move upward and then makes an impulsive move to the downside in the case of a supply zone, and the opposite for demand zone. So this, for example, is an example of a pivot created zone where price makes a quick move to the upside and then sell off immediately. Okay, quick move to the upside, then um, quick sell off. Okay, so if you are mapping out the pivot created zone, just use the candle, the candle that precedes the impulsive move. That's what you mark out. For example, in this one, the full candle, just mark it out. That is your that is your zone. That is your supply zone in this case. Okay, so you can see price tapped back into it and there is a sell off. Okay, in this case as well, you can see this um, zone. You can see this is a range created zone anyway. This is another example of a pivot created zone. That sharp move to the upside and then price sold off. So in this case, you could map out from the top to this candle. Okay, this is your zone. Okay, I'm still going to be talking about zone refinement. Okay, that allows you to refine your zones. Okay, so I'm still going to talk about that. But ideally, if I want to map out the whole zone, I'll just mark out the whole candle. Okay, that's your valid zone. All right. So that's the two different ways demand and supply zones are created via a range. A range forms on low time frame, and then there is an explosive move out of that range. Okay, or price makes a quick upward or downward move, and then proceeds in the opposite direction aggressively, with emphasis on aggressively. You can see the Marubuzo candlestick that forms. So if price should come to this zone later in the future, we will most likely see a significant reaction, especially considering the equal highs we have here and the trend line liquidity we have here. We should see a strong reaction from this point. Okay, so um that's on how supply and demand zones are created. Now, when you are also mapping out your supply and demand zones, it's important you also pay attention to the purpose of the zone. Okay, and when you are mapping out your supply and demand zone, you're either mapping it out for the purpose of as an area of interest or as a point of interest, or you are mapping it out to make an entry. Okay, you want to make an entry, especially on a lower time frame. Okay, like I've explained how I trade. I map out the supply zones. I wait for price to tap into it. I go to the lower time frame, 15 minutes, 5 minutes, 3 minutes, and then I wait for confirmation in the form of market structure shifts. Okay, which I have explained in previous videos. Okay, so when I'm mapping out supply or demand zone for the same as an area of interest, I'm just waiting for price to get into it. Okay, I usually try to make the zone as large as possible. For example, in this case, if I want to map this out, I'll probably just map the whole of this zone. Okay, um from the low of the range to the high of the range. Okay, that's my area of interest. That's the area I'm interested in. Okay, if I'm going to map out this, for example, you can see the whole of this zone is my area of interest. I'm just mapping it out as an area of interest. I'm not mapping it out for the sake of taking a trade. So I will not place a limit order here. Okay, so I'm just mapping it out for the sake of me taking a trade, for the sake of just waiting for price to trade into it, and then I go to the lower time frame and start studying price action for an entry. Okay, so and that's one purpose. The other purpose is if I'm intentionally mapping it out for the sake of making an entry, I want to make it as small as possible. I want to make it small so that I can maximize my risk to reward ratio, so that my stop loss percentage will be low. And the lower my stop loss percentage, the higher my risk to reward ratio. Okay, so depending on the purpose, the reason why I'm mapping out that zone, um, I can map it differently. Okay, in this case now, if I'm mapping this just for the sake of um, just to study how price react to it, and then looking for an entry on the lower time frame after market structure shifts, I want to make it map it out like this. But if I'm looking to place a limit order without waiting for confirmation, I would want to refine it. Okay, maybe to this area to reduce my stop loss percentage. Okay, so then I place my limit order here, my stop loss here. All right, so depending on the purpose for which I am mapping it out, the way you map it out might be a little bit different. Okay, so I map out, if it's just an area of interest, I make it as big as possible so that I can catch any opportunity that presents itself on a lower time frame. Right, and if it is for an entry, I want to make it smaller so that my stop loss percentage is small, and so that my RR will be higher. Okay, so that's that on mapping out supply and demand zone depending on the purpose of the zone. Okay, next, I'm going to talk about um, how you refine your entry zones. Okay, for example, you've mapped out your supply and demand zone for the purpose of making an entry. Okay, how do you refine it? Okay, now there are four different kind of refinements you can do to your supply and demand zone. Number one, there is the time frame refinement. Okay, the time frame refinement is basically when you refine a higher time frame zone, you reduce it to a lower time frame zone. For example, this particular zone right here, if I should go to the 1 hour time frame, if I should go to the 1 hour time frame, you can see that I could have refined this, okay, to this first candle. So I could have reduced it to this candle. all right, just this candle to make my stop loss percentage small. In this case, I would not have been picked. Okay, so that's basically what time frame refinement is. Maybe you have a 15 minute zone and you can narrow down to the 5 minute, 3 minute, 2 minute to refine your zone so that your stop loss percentage will be lower. So that's basically time frame refinement. And you also have candle wick refinement. Candle wick refinement is basically when you have your zone. Remember what I explained about pivot created zones. This is an example of a pivot created zone. Price shoots to the upside and then went and then sold off aggressively. You can see the Marubuzo candle showing that there is a lot of um, sell pressure. Okay, so if I want to map this out, ideally, I'm going to map out the whole of this area. The whole of this area. Okay, this is a buy to sell candle. Okay, this is what I call a buy to sell candle. So, um, but this would be too large. Like if I'm placing an order here, it's going to be too large. The distance is going to be too large. So if I'm looking to refine using the wick, um, I'm going to use. There are two ways to use wicks. Okay, if the full candle, okay, another way I could have refined this is using this, especially considering the imbalance that is just before it. Okay, so I could have just used this or map out the whole of this candle. Okay, but um if I want to refine it, I'm going to use just the wick. Okay, usually if the length of the wick is bigger than the length of the body. Okay, if it's greater than 50%, that's when you want to use the wick. Or if you have a situation like this where the candle that you would have used is not higher up, like there is no sell order here. Okay, because the orders that are in this candle would have been consumed with the way price moved up. Okay, it would have been consumed. So this is where you have the resting orders. That's where you want to use. Okay, so you can either refine the wick based on the 50% rule that if the wick is bigger than the body, then you use another example is this one. If the wick is bigger than the body of the candle, that's your valid zone. Okay, so if price taps into it, then expect that it's going to sell off. All right, so that's weak um, refinement. Okay, and you also have equilibrium refinement. Okay, equilibrium refinement is when you reduce your wick to the midline. Okay, to the midline. Remember, I adjusted my zone to this area. So if I want to still refine it further, I can just draw a fib 1, 0.5, and I use that as my entry. Okay, so when price taps into it, then sells off. Okay, so I can decide to place my order here instead of here. Okay, 50%. It's totally optional. You don't have to do it. I have so many trades, beautiful trades where I don't get picked because I was trying to use the midline or the equilibrium of the zone instead of um the base of the zone. Okay, so it depends. At times you'll be picked, at times you will not be picked. Okay, imagine if there was no retest. Imagine after this market structure shifts, a price just trades maybe to this level and sell off. It would not have picked you. So if you are okay with the stop loss percentage of the zone, then feel free to place your order at the limit. You don't have to use the 50% equilibrium rule. Okay. The last refinement I'm going to talk about is mitigation refinement, mitigation refinement. Okay, so we can see from here that this is the zone. Okay, price has tapped into the zone and there is a sell off. Okay, so I can decide to adjust my zone to I can decide to adjust the zone to the part that is yet to be mitigated. Okay, so I reduce it to this candle since the orders that are below this level has already been consumed. Okay, so that's mitigation refinement. That's how you refine your zones. Okay, so refinement is optional. It depends on you. If your stop loss percentage is all right, okay, you're okay with the stop loss percentage, you're okay with the RR based on the stop loss percentage, you don't have to refine your zone. Okay, so it's not necessary, it's completely optional. But personally, I like to refine it. I don't like a high stop loss percentage. I want it to be such that once price tap into my entry, there is an immediate sell off. I don't like to see price spending too much time within my stop loss zone. I don't like it. Oftentimes, when that is happening, I may even close the trade. Okay, because what it simply means is that there isn't a lot of order to push price down. And in most instances, when price is dancing within my zone, especially if it is well refined, most of the time it takes out my stop loss. Okay, so what you want to see for a valid zone is once price gets in there, you want to see an aggressive sell off. Once price taps into that zone, you want to see that aggressive sell off. All right, so um, that's pretty much how you refine your zone. Okay, now um, let me talk about mitigated and unmitigated zones. All right, mitigated zone is a zone that price has tapped back into. Okay, so for example, this zone before price trades into it, you would say that this zone before price taps into it, you will say that it is yet to be mitigated. Okay, so once price taps into it, um, it becomes mitigated. Okay, this is not full mitigation. This is like a partial mitigation. So as long as that zone has not been completely as long as the zone is not completely mitigated, it will most likely still produce a reaction. Okay, so price taps into it, becomes partially mitigated, price taps into it again. Once it goes below 50%, personally I consider it to be fully mitigated. That's my own personal preference. Once it does 50%, I assume that it is completely mitigated. But usually, if it is not 100% mitigated, it will usually most of the time produce a reaction. Okay, so it's important to know that. So mitigated zones are zones that price has tapped into, and unmitigated zones are fresh zones that price is yet to trade into. For example, this is a good example of a zone of an unmitigated zone. So this zone, if we go to the 4-hour time frame, you see that this zone is yet to be mitigated. This zone haven't been mitigated, and this zone right here haven't been mitigated. Okay, so this is an unmitigated zone, this is an unmitigated zone. Every other zone here, this has been mitigated, this has been mitigated, this zone has been mitigated. Okay, has been mitigated. All right, so that's pretty much what you call a mitigated zone. All right. Okay, next, you will realize that there are times some zone will hold, there are other times when a zone will not hold. Okay, so how do you map out a high probability zone? Okay, so let's quickly look at how you can map out high probability supply and demand zones. Okay, things you should pay attention to, things you should be looking at. Okay. Okay, the first thing you want to pay attention to when you are mapping out your supply and demand zone is that there is aggressive sell-off from that zone. Okay, there is aggressive sell-off. For example, look at this supply zone right here. You can see how price aggressively sold off. You can see the Marubuzo candles, the red Marubuzo candles. Okay, so once you see a strong sell-off from the zone, then that zone is more likely going to hold. Okay. Another thing you want to pay attention to is the presence of imbalance. Okay, FVG, fair value gap, price imbalance. What price balance simply means that only sellers are in control. Okay, so it shows how aggressive the move is. The wider the imbalance or the bigger the imbalance, the more likely the zone is going to hold. You can see even from here, despite the fact that price was aiming for Monday high, um, okay, there was still a significant reaction from this zone because of this fair value gap that you have here. Value gaps are liquidity, okay? So that liquidity. When you have fair value gap before the zone, number one, you would be confident that price is likely going to get to that level, okay? So if you look at this, for example, rejection could have happened from here. Okay, rejection could have happened from here, but there was rejection, but price eventually went back up again. Okay, so because of this fair value gap that is at the top here, okay, usually when you have fair value gap at the top of your entry, you might want to wait. You might want to wait to see if price is going to tap or take out the fair value gap. All right, so if you have fair value gap and there is an aggressive move away from that zone, then there is a high probability that that zone is going to hold. Okay. The next thing you want to pay attention is liquidity inducement. Okay, liquidity inducement. If liquidity is induced in the form of trend line liquidity or equal highs, equal lows, swing highs, swing lows. If you have swing highs, swing lows, or liquidity before the zone, the price is more likely going to reject from that zone. Okay, so that zone is most likely going to hold. So when you're mapping out your supply and demand zone, if you want to be very accurate, you want to map high probability zone, pay attention to price imbalance, pay attention to how aggressively price moves away from that zone, pay attention to um fair value gap. Okay, pay attention to fair value gap, pay attention to liquidity, and most importantly, the zone should break structure. Okay, the zone should be breaking a low for it to be valid. Okay, you can see this zone broke this low and price taps, price sold off. This zone broke this low, price taps into it, and there is a sell off. Okay, so you want to make sure that your zone is you want to make sure that your zone meets these criteria to stand a better chance of it holding. Okay, so if you don't want price to take out your stop loss, you want to ensure that you check out for these things. The more of these, it doesn't have to have all of this. Okay, it depends on you. Ultimately, there are times when you won't have a fair value gap and the zone will still hold. There are times when liquidity won't be induced and the zone will still hold. But personally, I don't like to take a trade except liquidity is induced. Okay, so but the more of these factors you have, the more high probability the zone is going to be. Okay, so you check for price imbalance before the zone, check for liquidity before the zone, make sure the zone is breaking a significant structure, okay, it's breaking a low, okay, and also make sure that price aggressively moves away from that zone. One last thing you want to pay attention to is that um, price is at premium or at discount. Okay, for example, If the supply zone is at premium, it is more likely going to hold. And if demand zone is at discount, it is more likely going to hold. So what is premium discount equilibrium? Basically, when you draw a fib, you can see this is a fib from the high of the previous swing leg. This is the high, this is the low. So you draw a swing from the high to the low. You want to make sure that your supply zone is above 50% when you are looking for a short, and below 50% if you are looking, I mean below 50%, that's 0.5 level equilibrium when you are looking for a long. Okay, that's basically the concept of premium discount and equilibrium. So um if you can see from here that the supply zone is above the 0.5 level, so it has more, it is more likely going to hold. Okay, if your supply zone is at the midline, you can see this is a zone here. Okay, you can see this is a zone, this is a supply zone, but it didn't hold because it's exactly at equilibrium. Okay, so you want to wait for price to trade above the equilibrium level. Preferably, when you start approaching the 618, the golden pockets, 0.7 up and above, that's when you want to start looking for longs on the supply zone. So when you're mapping out your supply zone, you want to check to be sure that your supply zone is above the equilibrium level when you draw a fib from the high to the low of the previous impulse leg. All right. So these are the once you check that your supply zone meets all of these criteria, or your demand zone meets all of these criteria, it is more likely going to hold. Okay, it is more likely going to hold. All right. So and that last thing you want to pay attention to um is the concept of the consolidation. Okay, consolidation, usually when you see consolidation before a zone, as in this case for example, when you see consolidation below a zone, um there is a high probability that that zone, especially if price trade away from that zone and then is coming back into it, there's a high probability that that zone would be taken out. Okay, what this means is, I told you when you have this is a range created zone. Okay, in this case, a range created demand, I mean supply zone, and price sold off away from it. What it means is that they sold off. Okay, what it means are here they sold off in order to buy. Okay, resting on this level is sell side liquidity, and sell side liquidity is where the big money players are looking to buy. So this consolidation here means that they are building their sell order. Okay, so they sold off here, so they push price to this level so that they can buy. So they've bought and they will need to sell higher. And where do they sell? Where do smart money sell? Smart money sell above its 0.5 level. So when you say demand zone like this at the equilibrium line, there is high probability, especially when you see consolidation below it and then price trade off away from it, it is most likely going to take it out. Okay, it is most likely going to take it out. All right, so that's something you need to pay attention to. All right, now let me explain entry zones. Okay, I explained initially that how you map out your supply and demand zones depends on the purpose. Okay, if you are mapping it out for the sake of like studying how price react to that zone, looking for confirmation in within that zone, you want to map out the whole zone. You want to make it as big as possible. Okay, and when you are mapping it out for the sake or for the purpose of making an entry, you want to make it smaller. All right, so let me talk about decisional zones and decisional zones and extreme zones. Okay, decisional zone is the zone that breaks structure. Okay, I'm trying to look for examples. Decisional zone is the zone that forms just before it breaks structure. Why the extreme zone is the first zone that forms before a break of structure. Okay, so this is a very good example. This is a very good example of um, decisional and um, and extreme zone. In this case now, this is the extreme zone. Okay, this is the extreme zone, and this is the decisional zone when we are looking at this high before it breaks. Okay, so price will either, if I refine this to this level, okay, so price would either come to the extreme or to the decisional. Okay, so where do you use when you are looking to make an entry? Personally, I would only enter if the decisional zone sweeps liquidity or liquidity is induced before it. That's my own personal preference. If it sweeps liquidity and or liquidity is induced before it, then I wouldn't mind taking it. Let me show you another example. Okay, this was a quick trade I took today. Um, when you look at the overall confluence, price took from the low, from the high, deviation and then retest, and I was targeting the range high, but I decided to target the closest liquidity. Okay, so price could still maybe go for the high, but that's not what I'm trying to explain. Anyway, I'm just trying to explain the reason why I took the trade. Okay, so it was a quick trade. I think how many hours? 8 hour, thereabouts. Yeah, 8 hour. So why did I take it? Based on decisional and and extreme zones. Okay, once you have price forms a high, forms a low. This is a high that needs to be broken for us to have a market structure shift. Okay, now every other zone that forms before the break of this structure is a decisional zone. So you can have multiple decisional zones. So before market structure shifts, any zone that forms before market structure shifts after the extreme zone is the decisional zone. So this is a decisional zone, this is a decisional zone, this is a decisional zone, and this is the extreme zone. Okay, the lowest possible zone. So maybe here, okay, if I'm looking to refine it, this is the extreme zone. All right. So now, usually decisional zones are mostly formed when you see a flip, a supply to demand flip or a demand to supply flip. Okay. So a flip is basically when price reacts to a zone and then proceeds to break it. Okay. For example, you can see that there is a supply zone here, and what we see here is price reacted to that zone before it then proceed to break structure. So this is a decisional zone. So the zone that forms before that break of structure is the decisional zone after reaction to the zone. So this is both a flip zone and a decisional zone. Okay, so when I'm looking to make your entry, you want to pay attention to what price is doing before it breaks structure. Let me show you some models and I'll come back here to explain. Okay. So here I let me delete this. I shared this model on the Telegram group page. Okay, yeah. So this is a zone. This is how you know if you should use the extreme zone or the decisional zone. If the decisional zone takes liquidity in the form of swing low, equal highs, trend line, if it takes liquidity before it breaks structure, that's decisional zone is more likely going to hold. So that's what you want to use. Okay, and even if you use it and it takes you out, that's just a -1 hour or -0.5 hour if you are managing your risk, and just come next to the extreme zone. But in most instances, when price takes out the decisional zone after it takes liquidity, there is a very high probability that it will take out the extreme zone as well. Okay, so if price takes out the decisional zone, I'm not usually very confident that the extreme zone will hold. Okay, but I still try to trade it, and sometimes it will hold, sometimes it will not hold. But usually, when you have a flip zone like this, price trades into supply, reacts to the supply before it then broke structure. That's what you call a supply failure. So it means that supply was unable to form, break this low. Okay, it was unable to break this low, then that means it has failed. Okay, so if it takes liquidity before it breaks structure, use decisional zone. Okay, if there is no liquidity before it breaks, you can see this is the flip zone. Price trades into supply, react to it, and then break structure. This is a flip zone. If there is no liquidity inducement before the zone and the zone does not take liquidity, don't use the decisional zone, use the extreme zone. Okay, but if liquidity is induced before the zone, then you can use the decisional zone. So that's basically what you want to pay attention to when you are choosing between the decisional zone and the extreme zone. Okay, so let me go back to this example I was trying to show you. You can see from here that we have a flip, price trade into this supply zone and reacted to it, but didn't break this low. Okay, it didn't form a new low. And you can see it took liquidity. This is more like an equal high, relatively equal low rather. So it took this low, it took this low, okay, took this low, so it took liquidity. So there was a liquidity sweep before it then went on to break the high, and price is returning back. When price is returning back, you can see that liquidity was induced. You can see this trend line liquidity before this decisional zone. So that was why I had more confidence to take the trade at decisional zone instead of this extreme, and price traded up for a quick 8.5 hour. Okay, so that's something you want to pay attention to. All right, so if the decisional zone or the flip zone takes liquidity, or liquidity is built or induced before the zone, then you can be confident to use the decisional zone or the flip zone. Okay, so the last thing I'm going to talk about is how valid is the zone. Okay, how long is a zone valid? How long? Okay, a zone is going to be as valid as long as it has not been mitigated. You always still see a reaction. Let me show you an example on BTC. Um, for those of you on Crypto Academy, there was a time when BTC was dropping aggressively. I think the last time BTC was dropping aggressively, that was around December, and I said it was going to bounce from 42.6K. This is exactly why I said so. Okay, because this is 2021, September 2021. So this took like September, this is November, September, October, November. So that's like almost about 3 months before price tapped into it, and you can see the strong reaction to the price. This is the supply zone. Okay, you can see this meets our criteria. Okay, there is aggressive move away from the zone. There is fair value gap in the zone. The zone breaks structure, multiple structure. Break this structure, break this structure. Okay, here there is really no liquidity. Maybe this is the only liquidity before the zone, right? So, like I said, all those factors I mentioned, you don't have, all of them does not have to tick. Okay, once you have enough of those, then you can feel confident to take. So, this trade you could have placed a limit order here and your stop loss somewhere here. But personally, I wouldn't take this because I like to see confirmation. Okay, but if you are not as conservative as I am, you can just place an order here, your stop loss somewhere here, and maybe target the next zone. In this case, now price didn't get there. Um, in this case, price didn't get there. But usually that's what you would want to target. All right, so that's pretty much all you need to know about supply and demand zone. Now, let me also say that even if a supply or demand zone meets all of those factors that I mentioned, if it meets all of those factors that I mentioned, it doesn't guarantee that that zone is going to hold. It increases the probability of it holding, but it's important you know that trading is a game of probability. Okay, so there is no absolute. What you think is a high probability zone might end up not holding, and what you think is a low probability zone might end up holding. So that's just the reality of it. Okay, so it's important you always manage your risk irrespective of how high probability you think the trade or the zone is. It's important you manage your risk and you use a stop loss. All right. If you have any question, you can always drop your question in the comment section. I would definitely can be sure I will answer them.